Welcome to Fear and Greed, the week ahead. I'm Sean Aylmer, and as always, I'm joined at this time on a Monday morning by economist Stephen Koukoulas. You'll find him at thekouk.com, TheKouk, thekouk.com, and on Twitter using the handle thekouk. Stephen, good morning.
And an exceedingly good morning to you, Sean.
Indeed. Have you recovered from last week's budget?
I have. I had a lovely, lazy weekend. And as alluded to, I think on the day after the budget, I watched a bit of the footy and enjoyed the horse racing. Back to winner or two. So things are good as we kick off the new week.
Excellent. Now, before we kick off the new week, we've got some important stats out this week around the labour force and wages and things. Let's just quickly do a debrief on last week. By the time we got to the end of the week, we had the Federal Treasury's budget forecast. We know what the surplus is going to be this year, then deficits beyond. We know about retail sales. We know about the National Australia Bank Business Survey. Where is the economy at the moment?
That's a terrific question. I think there's a couple of things that I'd like to frame around the data that came out last week and the budget, and sort of what we've been knowing has been trending in different parts of the economy for the last couple of months. And first of all, the economy is slowing down. There's no doubt about that. The retail sales numbers for the March quarter in volume terms were negative, so the second consecutive quarter of negative retail sales growth. So consumers are responding to cost of living pressures, to the interest rate hikes that have been delivered, and that's a slowdown that we had to have. You know, the economy just was growing too strongly in the middle of 2022, so the slowdown's happening. That's one thing. The other one with that, and this is sort of both domestic, but also we saw the US inflation data in the middle of last week, and that confirmed that inflation pressures are easing. There's this question about whether if they're easing rapidly enough to satisfy central banks and financial markets, but nonetheless, the inflation rate continues to tick down. So that is the sort of number one issue, I think, for investors and financial markets, both in Australia and around the world. Inflation falling, good. How quickly? And then where do we get to the target sort of ranges again is the big question. And for the budget, well, and I think the morning after we had a bit of an assessment, and I think with the following few days of analysis and hearing the Treasurer and the opposition discussing the budget, it confirmed what I think we said on the morning, that it's a solid effort. You know, it's not the sort of budget that shoots the lights out and changes the sort of structure of the economy that much, but it did a few things. It took steps in the right direction, and seeing a budget surplus is not a bad thing when you've got unemployment at 3.5% and what was inflation very high. So if you're going to get a surplus, that's when you do it.
Okay. That was last week. Let's talk about this week, because some really important information out this week, particularly around interest rates. The first one is the labour force data for the month of April.
Very important, and that's been the sort of rock of Gibraltar in a sense for the economy. It has been the strong part of the economy when, as we were just sort of saying, things like retail sales are turning down, new building approvals are turning down, consumer sentiment's pretty weak. The thing that's been resilient, in fact, better than resilient, has been the labour market. We're expecting still another increase in employment, but a much lower rate of increase. The last few months we've had numbers of the 30, 40, 50,000 per month increase in employment. We're probably going to be getting a pairing back to sort of plus 15 to 20,000 on employment. The unemployment rate, which has been hovering just above a 50-year low at 3.5%, is probably going to tick up a tenth to 3.6%. And that's just in line with the slowing in the economy. So in one sense, the numbers are still very good, but there's a turning point that appears to be happening in employment and, importantly, the unemployment rate.
What about the wage costs? So the wage price index is out this week. Explain what that is and why it matters.
Wages are an important part of the services inflation in the sense that if you're providing a goods business, the price of those things, just think of a petrol station. It's not the wage that we pay the person behind the counter that's going to be the dominant issue in the price of petrol. It's the price of petrol. But if you're a tradesperson and you're the one who turns up and provides the service to, hammer in some nails or fix your plumbing, it's the price of labour that matters. And I think that's where the wage price index comes into it. And it has been starting to pick up. So that's good news in a sense, because it was ridiculously low during the pandemic. And even in the years prior to the pandemic, we knew that real wages were very, very soggy and some increase was inevitably going to happen, and it is. So looking forward to the data later this week, we're probably going to see that annual increase in the wage price index tick up towards around 3.7, 3.8%. A result that I think everyone would be happy with, But as we've heard the Reserve Bank governor and others at the central bank talking about in recent months, be careful you don't get too much of a good thing. So wages, while we want them to be sort of rising at a reasonable pace, if we start getting annual wage increases at sort of 4.25%, 4.5%, then of course you run into some inflation pressures there. We're not there yet, but that's why the quarter-on-quarter result will be so interesting. So a figure that's 1% quarter-on-quarter or 0.9 or 0.8 is pretty good. If we get a 1.2, then I think we'd be not concerned, but just sort of looking at the wage risks, sort of sustaining inflation a little higher for a little longer.
The other one that'll be interesting comes out tomorrow. It's the minutes from the Reserve Bank board meeting 2 weeks ago when, of course, they lifted interest rates, which surprised many.
Oh, I still haven't recovered from that, really, that shock interest rate hike, because I think the market gave it a very, very low probability, and I was one of those who got it wrong as well. So what actually they were looking at, so the minutes of that actual meeting will be more than they're interesting than normal, that we'll be sort of going over them. Why did they actually pull the trigger when, they paused in April, and the rhetoric during the month of April, we're probably going to pause again. We want to wait and see the impact of the prior rate hikes before we consider a future move. So what forced them to sort of change what seems to be relatively abruptly and then deliver the 11th interest rate hike will be something that I think we'll all be poring over tomorrow when those minutes are released.
Well, it's probably not quite as big a week this week as last week, Stephen, but there's still plenty to chew on for the economists out there.
Plenty to chew on. The labour market issues are the defining thing, I think, whether we get another rate hike or not, because we do know that, as we were saying before, the economy's slowing down, inflation's coming down. If the labour market remains unexpectedly strong, let's say, wages are unexpectedly strong, then the Reserve Bank would be more than concerned that it's not going to get inflation back to target anytime soon. That's the thing that's going to be really important for the markets when they sort of start pricing in, well, what's the next move in rates, up or down, and when does that happen?
Stephen, enjoy your week.
Thank you, Sean.
That was economist Stephen Koukoulas, better known as The Kouk. You can find him at thekouk.com and follow him on Twitter using the handle The Kouk. I'm Sean Aylmer, and this is Fear and Greed, the week ahead.